right, welcome everyone to another episode of the Week in Italian Startup. And today we have a big, interesting deep dive into some numbers, talking about the BlackRock and the TrackVC platform. But first, Nick, let's go through maybe the news of the last week. Things are moving, and I'm glad that bigger and bigger rounds are happening, and things are basically getting back a little bit at speed, and that's a very positive element. So maybe let's talk about the three news that you mentioned. So Tretao raising 20 million euro in Series C from T2Y Capital, CDP, Finindus, Mitotech, and Santander Alternative Investments. Let's go maybe one by one, and then I'm sure there is like an interesting pattern that you wanna mention. So Sillotips raising 4.2 million euro in a seed round from Azimut Tech Shop, Cloud Accelerator, Leo Capital, and then Pillar raising 3.2 in a pre-seed round from Emblem, Pareto, Plug and Play, Kima, Biros, Vento, Eden Venture, Siag, and a few angel investors. So pattern-wise, what do you see, Nick, here?
I think there is one interesting point to take home from what's happening last week in particular, but also in the previous weeks, and I think we will see more of it later going forward, is that rounds are highly syndicated, so there are a lot of investors participating in the rounds, and we start seeing consistently a few international investors investing in Italian startups. Emblem, Entourage, it's a name that I think we will hear more often. T2Y is probably very vertical in the 3000 segment, but still international. So I think that's very interesting. So finally, it appears that our very early stage ecosystem is connecting across geographies, at least throughout Europe. And that's, I believe, very good news. So the trend is the right one now.
Do you think there was a trigger event for that, or you think it's more of a natural progression? Because we've seen internationals, but it's very more kind of sparingly here and there. There is not such a big sort of consistency that seems to emerge. What is your feel on this?
I don't know there was a specific trigger event, like a specific cause for this to happen. It's more like, slowly than suddenly. But remember, I am a great advocate of this trend of entrepreneurs that have had international experiences, international exposure, and then coming back. These international experiences and exposure mean building networks outside of the usual ones in our geography. That means that you have more reach when you present yourself to the market, and that's the pull part of the pull side of the story, and then there's the push side of the story. Meaning, whatever you think, I believe that Europe is becoming a very tough environment for the early stage investments. Tough meaning there are a lot of operators, there's a lot of capital, and there's a lot of competition to getting the best deals. And some geographies are becoming expensive. France in particular, but others as well. So there are good investors that have the capabilities to move abroad and have identified ours as a market with still good prices and good entrepreneurs to invest in. So I think this is a trend that has been brewing for months now, and now we are starting to see the results of this.
Yeah, and this is definitely in line with what we're going to see later when it comes to data for European VC firms, according to regarding DPIs and returns. So maybe that's it's a little bit of a turning point. I agree. So finally, we're seeing the fruits of Italian founders basically building networks abroad and coming back, and then pulling back investors and new networks. I think is a very, very great point. Very interesting. All right, really quick, let's talk about TIP, listed shareholder in Bending Spoons, updating the value of its holding, valuing it at 5 billion. So again, Bending Spoon in the news. Definitely like a sort of something pushing toward what we've been seeing and maybe sort of projecting, which is not only a big valuation, but potentially like something where Bending Spoon can actually maybe go public at some point. So how do you interpret this news, Nick?
Well, man, I mean, it's super interesting. I think, a shareholder with 2% or something of the company marking it up, is this the beginning of something like getting ready for any next steps, any next step, including IPO? That would be interesting to discover. Even though if you consider the latest operations by Ben Spoon, the last acquisition of Vimeo, so it makes sense to take a look at the evaluation of your portfolio company, but still, you do it with some reason. I think.
Yeah, and my question, I mean, my first reaction is for a big operator like Tip, how easy or difficult is it to mark up like an investment, like in this specific case? Because someone maybe looking it from outside can say, hey, I can discretionally sort of round up a few numbers here. So I was wondering how easy or difficult it is, what maybe if there are barriers, because there's no really like standardized way to do that, being like private markets. There are best accounting practices, absolutely yes, and that's basically the problem with VC in general that we'll probably see also in the reporting, where it's not as standardized as public markets. So my doubt is that like how this markup is backed and why. Yeah, so that's really the question.
That's a very good question. So either something happens, some external operation happens that allowed them to mark it up, or they actually employed some reason to impair or reevaluate the stake. I have no idea. I mean, the EPEB guidelines are there for everybody. I'm not sure TIP follows the EPEB guidelines, but that I wouldn't say strict, but quite clear in when is a good time to impair or reevaluate and when, better not. So either something happens and we still don't know about it, or it was a good moment to mark it up.
Awesome. All right, so let's talk about one of the big sort of a little bit like I would say market shift like toward transparency for the VC industry in Europe. So last week, the European Investment Fund and BlackRock released a TrackVC, which is a dashboard showing aggregate statistics around venture capital and private equity performance-wise, specifically in Europe. So this is a big deal because it's kind of one of the first aggregated data source that are kind of official from some of the big operators. So the European Investment Fund is basically invested in a lot of European VCs. So as an LPs and institutional LPs, they have like a lot of visibility on one side. BlackRock on the other side, through their own tool, which is eFront Insights, they also managed to actually pull together a lot of data. So it is definitely a big deal. It's a good news, and it's a good way to have like a nice, solid, for what it can be with all the limitation that we can talk about for private markets, venture capital, and private equity. Yeah. What was your reaction?
It was like, wow, so finally I can benchmark officially. No, it's super interesting to have this type of information published with some delay. The latest data is up to date to 30th of September last year. So 1 year behind, but still fine. Since VC and private equity, VC in particular is for the long game, so you have a broad idea where things are going. And I have to say, since the US have a lot more publications in this matter, it's very nice to start being able to compare the different geographies and see how we stand one next to the other. And when I say United States, I mean AngelList is a platform where a lot of funds are actually managed. and Carta is probably the market leader for fund management software and services. So they both publish the state of venture capital, and it's super interesting to see the numbers, how they compare with Europe, and that's what they did in the last issue of the newsletter.
So let's talk about the assumptions that you were a little bit hinting toward. So first of all, the data in the platforms are basically GP reported. So the GP is essentially providing data to the institutional LPs. So that's one first thing to take into account, I would say. Secondly, one thing to take into account is the fact that there are basically 586 funds since vintage 2014 that basically have been accounted for. And then just to start, the difference between, well, it's important to remember the difference between interim performance and final performance. All the data are interim performance, which is essentially funds are still active. They're still investing and divesting. Well, not all investing, but some of them are still investing. Some returned, some didn't. So it's all metric that are interim. So I think there's one thing to point out, which I don't think it needs to be clarified. Yeah.
Yeah, good point. I didn't dive too much into these things, but you're absolutely correct. So what we are seeing are numbers that are in theory, and we need to remember that on average, venture capital funds have a 10 years lifespan. And since data comes from funds vintage 2017, so launched in 2017, they still have at least, well, at the time of data, 3 years ahead of them, on average, 2.5 years, let's say. So they're far away from the final liquidation. So anything that we are seeing there is, numbers that take a snapshot at a certain point of time of numbers that are either self-reported by GPs or collected by the platform, because Carta knows what you're doing. So it's even more realistic in some sense, even though I do not expect some many discrepancies.
Yeah, totally. So yeah, one point that I was just to dive right into the data. So essentially they show like 3 of the main indicator that essentially are useful to understand the performance of VC funds. So for listeners that are not too keen on this, basically there are like 3 main indicator: DPI, TVPI, and IRR. Basically measuring different things. Let me give an overview. So DPI is essentially how much cash has been returned to investor relative to paid-in capital. So DPI stands distributed to paid-in capital. TVPI also measure not only the distributed capital, but also the value that's still in portfolio, but not yet cashed out. So it's an overall metrics, I would say. And then IRR, specifically in this case is net IRR, is basically the measure that annualizes the rate of return net of essentially what are the fees, the carried interest, and the fund expenses. So just to give like a rough overview. So one point which I wanted to make is everything shows the classic J curve where returns tend to be negative the first years and then they kind of start growing. And trailing on that, my feel was that, okay, we should probably just put the right weight only for funds, let's say between 2017 and 20, because from 21 after, it's kind of unfair, I think. So my feel is that if we really want to have a solid grasp of what's happening in the VC, of course, it's a delayed metric, it's a lagging metric, but I would stick with, 17, 18, 19, maybe even better. It's way more realistic. What do you think about this, Nick?
No, I agree with you. If you want to have a hunch of how VC as an asset class is performing, of course, you need to look at the older vintages. If you want to benchmark, it's interesting also to take a look at the youngest vintages. So for us, it's very relevant to benchmark against the most recent vintages. Our latest fund is from 2022, so it's super interesting to know what's going on in the big picture. But if you want to find an answer to the question, is VC actually performing? You probably should take a look at 2017, 2018, and then you have a rough idea. even though, as you mentioned, I strongly believe in the J curve. That means that the final numbers will only materialize at the very end of the fund's lifetime. So year 9, year 10, maybe year 11, since many funds extend the lifetime, but that's a decision that you need to run through your LPs. So it's super interesting to take a look and see the curve growing somehow.
Yeah, I think let's jump to the main conclusion, which I think there is what you kind of think about it as the DPI truth, which is at the end of the day, the distribution between European funds and US fund, they kind of tend to converge. So the general feeling that European funds are worse, underperforming, they don't take risk, etc. Well, I don't know. There's a challenging. It's kind of challenge that views is challenged. DPIs seems to converge, and that was your main point, I think. What's your feeling on this?
I agree. Again, so as I mentioned, the real monetization will happen at the very end of the life of these funds. That means that even if you take a look at the 2017 vintage and you see this huge discrepancy between the TVPI in the US and the TVPI in Europe, it's like, it makes me cry if you take a look at that number in isolation. It's like 4 times invested capital versus 1.5 in the same percentile. It's like, oh, something is deeply wrong there. But then you think maybe there are some differences in accounting, as you mentioned, in the way that in Europe we mark to market, or in the way that rounds tend to scatter across geographies. And there might be explanations that are outside of the actual value of the portfolio. But then, as you mentioned, you take a look at DPI, meaning real money given back to LPs, and things are still not the same. So to be honest, the data from AngelList is much better if you are an LP in the AngelList fund. In the 75th percentile in AngelList, you are much happier than the 75th in the TrackVC data set. But still, they're closer, like 0.4 something versus 0.6 something, right? It's a 50% difference, not 4 times as much difference. And that says something. So the markets are a bit closer than we maybe expected.
Yeah, totally agree. What is some other highlights that you feel you can gain from the data?
Well, this was the most important one.
Maybe something. I was thinking actually about the difference between sort of difference in the percentiles. So the interquartile sort of percentiles. Europe between the 50th and the 75th, we have a huge gap for US-based funds and a lesser gap in European funds. So one way to think about it would be, are European funds sort of better at risk management overall, while US fund, they take like big swings, and that justifies the big swing. So in terms of a risk management perspective, I was kind of going around with this concept. I don't know if it's something that you thought about.
This is an interesting point. I have no idea whether I would, think of it as risk management, or some kind of, feature in the market that's somehow different. It might be that so that's a smaller gap. Might be an indicator that something is different in the valuation, in the quantity of the Series B, C's, D's the rounds that you would be enjoying as an investor from the 2017 vintage today in 2023, 2024. So there is some difference there, because usually you reevaluate the portfolio when there is a third party giving a new price to your portfolio company. So either that's not happening, or there is something else going on the underlying assets. Because what surprised me is the number on the 75th percentile. So that number is weird. It's quite low. It's 1.4 total value over AD. That surprises me.
Interesting.
I have to say.
All right, Nick. Thank you so much for joining. It was a super interesting conversation, and running out of time. So I'll see you next week then.